Right now, inside filing cabinets and recycling bins across Canada, thousands of seniors are unknowingly throwing away massive annual savings. We aren't talking about deceptive mail or promotional flyers. We are talking about your official Notice of Assessment from the Canada Revenue Agency. If you ignored this document or missed the tax filing deadline this year, you might have inadvertently cut yourself off from 5 substantial cost-cutting programs established by federal and provincial governments. Many retirees are completely unaware of which everyday bills can actually be lowered, delayed, or wiped out entirely based strictly on their age and financial situation. And let's be fair, this isn't due to a lack of awareness on your part. It happens because the system is rarely explained in plain, straightforward language. That is exactly what we are going to fix today. Before we dive in, let me give you a straight answer, because your time and trust are incredibly important to this channel. There is no magical loophole or secret paperwork that instantly erases your monthly expenses. What does exist is a highly connected network linking your tax filings, your guaranteed income supplement records, and local provincial initiatives. When you manage this one central requirement properly, the entire network functions beautifully. If you miss it, the benefits stop dead in their tracks. Let's walk through the 5 primary areas where you can secure substantial relief, breaking it down calmly so you can see exactly how to apply it to your life. Let's start with one of the heaviest financial burdens for retired homeowners: property taxes. This expense never disappears, even when you transition to a fixed income. However, multiple provinces run dedicated property tax deferral initiatives engineered exclusively for older citizens. Take British Columbia, for example, which offers one of the most straightforward frameworks. If you are at least 55 years old, a surviving spouse of any age, or living with a disability, you can opt to have the province pay your property taxes on your behalf. This operates as an incredibly low-interest loan that you don't have to settle until you choose to sell the property or the estate is eventually wrapped up. This isn't an obscure rumor, it is a fully sanctioned provincial framework that thousands of retirees quietly use every year to safeguard their cash flow. Provinces like Ontario and Alberta manage their own distinct iterations of this support. Whether they are structured as tax deferral platforms or targeted low-income senior property tax credits, the goal remains identical: reducing your immediate out-of-pocket costs or extending deadlines so you never have to choose between keeping your lights on and paying the municipality. The reason this help goes unclaimed is simple. City halls do not call you up to advertise these programs. The responsibility falls on you to initiate the request, and your approval hinges completely on whether the government has your accurate current income data. Your annual tax return is the vital thread that ties this entire strategy together. Next, let's address the reality of Canadian winters and the steadily rising costs of keeping our homes warm. What many households overlook is that provincial utility providers are legally mandated in most regions to provide low-income energy support frameworks. In Ontario, as an example, the Ontario Electricity Support Program directly shaves money off your monthly bill if your household income sits below a designated cap. In other parts of the country, this relief is delivered via direct energy rebates, emergency utility funds, or dedicated senior credits managed by provincial regulatory boards. Here is the critical detail you need to remember. The qualification benchmarks for these utility discounts are almost universally calculated using the net income stated on your tax return. The exact same figure used to evaluate your guaranteed income supplement. If your documented income is inaccurate, outdated, or completely absent because your taxes were filed late, you risk much more than just a disruption to your federal pension top-ups. You are also inadvertently locking yourself out of reduced utility rates. These bureaucratic systems communicate with one another behind the scenes, even if that connection was never clearly explained to you before. Our third category is an expense that almost every senior encounters eventually: prescription drug costs. Managing health conditions in retirement often requires ongoing prescriptions, and covering these costs out of pocket can easily drain hundreds of dollars from your budget every month. Fortunately, every single province and territory across Canada manages a dedicated senior drug benefit initiative. Ontario residents utilize the Ontario Drug Benefit Program, while British Columbia, Alberta, Quebec, and the remaining provinces run their own variations. These plans ensure that your deductibles or copayments remain a tiny fraction of standard retail prices. However, a detail that catches many off guard is that these provincial drug frameworks do not always enroll you automatically. In numerous regions, an explicit registration process is required. Furthermore, the exact amount you are required to contribute toward your deductible is scaled directly against your total household income. Once again, that vital financial metric is pulled straight from your CRA Notice of Assessment. If your tax records are not fully up to date, your drug deductible could be anchored to a much higher income bracket than necessary, causing you to overpay silently every single time you visit the pharmacy counter. If this is the very first time you are seeing how interconnected these programs truly are, I highly encourage you to stick around for the rest of this breakdown. If you find this guide genuinely helpful, please consider subscribing to Canada Pension Hub. Our mission here is to routinely deliver clear, transparent, and plain language guides specifically tailored for Canadian retirees who want to stop guessing about their entitlements. Joining our community takes just 2 seconds, costs absolutely nothing, and guarantees you won't miss out on our upcoming updates. Let's move straight into our fourth major expense, dental care. For generations, oral health services were an expense that Canadian seniors had to shoulder entirely on their own, forcing many to skip essential treatments due to prohibitive pricing. That dynamic shifted dramatically with the rollout of the Canadian Dental Care Plan. This federal program was specifically established to support residents who lack private dental insurance and whose adjusted family net income falls below the $90,000 threshold. Depending on where your income sits within that bracket, the plan covers a massive portion of core dental treatments, ranging from basic cleanings and routine checkups to fillings and more advanced procedures. Even though older Canadians were the primary demographic this initiative was designed to protect, official data out of Ottawa reveals that an incredibly high number of qualifying seniors have still not submitted an application. They either don't realize the program is fully operational or assume that adult dental coverage simply isn't something the government provides. The plan is active right now, and you can apply directly through Service Canada, over the phone, or via their online portal. Our fifth category is one that rarely gets the attention it deserves, but in an era where healthcare appointments, banking, and government applications are handled online, a reliable phone and internet connection is a necessity, not a luxury. To address this, multiple major telecom providers across Canada participate in federal and provincial affordability initiatives, offering deeply discounted phone and internet service packages specifically for seniors and lower-income households. While the names of these packages vary depending on the specific provider you deal with, the core eligibility criteria always point right back to the exact same metric: your verified household income. Notice the unmistakable pattern connecting all 5 of these areas: property tax deferrals, utility bill reductions, reduced prescription drug deductibles, government-backed dental coverage tiers, discounted internet and phone packages. 5 completely separate expenses managed by entirely different organizations, yet every single one of them relies fundamentally on a solitary document: your annual income tax return and the precision of the data held by the CRA and Service Canada. Let's look directly at the underlying mechanism that makes or breaks this entire system. The primary tool that unlocks these benefits isn't a hidden archive. It is your Notice of Assessment paired alongside your Guaranteed Income Supplement profile. The GIS is a tax-free monthly benefit provided to lower-income retirees who are already receiving old-age security. In 2026, an individual senior can receive over $1,100 every single month through this supplement, provided their income qualifies. But here is the vital piece of the puzzle that often goes unmentioned. Your GIS amount is entirely recalculated every single year on July 1st. This calculation relies strictly on the income you reported on your tax return from the previous calendar year,